Thursday or Friday that they're going to inject 1 trillion yuan through the reverse repo. And this was not expected, and it's really unusual. And it's like $140 billion. So maybe they have some problems already in China. And I think they have problems as well in the US and Europe, especially. So I wouldn't be surprised that in the next 3 to 6 months, we see some kind of liquidity crunch and QE again.
China they're like on a different wavelength because their interest rates are going down and down and down, and the West interest rates are going up and up and up. I still think that when the West falls, China falls with it because they are the producers and we are the consumers.
As global markets strain under rising debt and diverging monetary policies, gold is once again emerging as the silent barometer of financial stress. Mario emphasized that although many people inquire about buying gold, they tend to delay until prices are significantly higher, potentially in the $5,000 to $6,000 range. He pointed to central banks already stepping in to support markets, highlighting the People's Bank of China's unexpected injection of 1 trillion yuan through reverse repos, equivalent to about $140 billion, as evidence of financial strain. He warned that both China and Western economies face similar vulnerabilities and suggested that within the next 3 to 6 months, another liquidity crunch could emerge, likely prompting renewed quantitative easing as central banks purchase government bonds. He also noted that Goldman Sachs projects gold could rise well above $4,000 by mid-2026 if the Federal Reserve's independence is undermined, a scenario he found especially significant. Rafi added context by clarifying that China's use of the term reverse repo corresponds to what would traditionally be called a repo in the West, an action that injects cash into the banking system. He observed that China's interest rates are moving steadily downward, in contrast to rising rates in the West, signaling divergent monetary policies. At the same time, he has been closely following long-dated bonds, particularly the UK 30-year, where yields have been climbing alongside those of Germany and France. This raises questions, in his view, about whether central banks are quietly intervening in bond markets. Before we dive deeper into the discussion on gold, silver, and the unfolding changes in the global monetary system, don't forget to like this video, subscribe to the channel, and hit the bell icon so you stay updated with every new insight.
While now the market expects the Fed to start cutting rates on the 17th, and I think I don't know if you agree with me. I think it's going to be a new rate cutting cycle. Is that the way you see it?
I don't know if it's going to be a cycle or if it's going to be like 150, 25, 50 basis point cut and then a crisis and then a cut to zero.
And I said, well, actually, it's the dollar that's going down in the currencies. And he was kind of, really? I said, yeah, well, it's inflation. And he said, is it easy to buy physical gold? I said, yeah, you can buy physical gold, coins. And I said, it's not bulky. And I gave him an example, the sovereigns, they're just under a quarter of an ounce. You can fit them in like a little tube that's the size of your finger, and you can fit 50 in there. And in pounds is worth about $31,000. So you could put 3 tubes in your pocket, and you've got like 100,000 pounds in your pocket. So I told him that, and he said, "Oh, really?" But I've had people ask me in the last few years many times about gold, whether they should buy it, and they never do it. But they'll probably start doing it when it gets to 5 or 6 thousand. I think silver will. And they never do it, but they'll probably start doing it when it gets to 5 or 6 thousand.
Oh,
I think
wait.
that could be
Well,
five.
silver.
That the central banks would step in to inject liquidity. And it looks like they're doing it already. The title of this live stream is to do with the PBOC because they announced on Friday, I think, yeah, Thursday or Friday, that they're going to inject 1 trillion yuan through the reverse repo. And this was not expected, and it's really unusual, and it's like $140 billion. So maybe they have some problems already in China, and I think they have problems as well in the US and Europe especially. So I wouldn't be surprised that in the next 3 to 6 months we see some kind of liquidity crunch and QE again. I don't know what you think about that.
Just a technical point here. I think this is the case. I think when China refers to reverse repo, they mean what we would mean by repo. I think they just got their terms
Yeah, they
wrong.
they are buying. I think they're buying the government bonds from the banking system and injecting cash into the banks. The
Yeah, so
U.S. is the other way
we would
around,
call
isn't it?
that's what we would call repo. In
Yeah,
China they call
yeah,
it reverse repo.
yeah,
Whatever. It means they're injecting cash into the banking
yeah,
system. I
yeah.
didn't hear about this. China is it they're like on a different wavelength because their interest rates are going down and down and down, and the West interest rates are going up and up and up. Um, I still think that when the West falls, China falls with it because they are the producers and we are the consumers. So if the consumers fall, the producers fall too. Like if you lose your customers, you lose your income. Or if the currency collapses in which you're getting your income, then you lose your income also. Uh, so why China would be injecting cash now? I mean, we know. I mean, the place is very opaque. It's still communist, except for the special economic zones that they allow freedom in, so they can supply the West with a bunch of stuff, so they can stack more dollars. But China's economy has been so fake for so long, and they still have these ghost towns and this whole real estate bubble throughout the whole country, and it's still like a very corrupt, disgusting regime. I mean, we're not allowed. We don't really say that because the West gets most of its stuff from China, but that's still the reality, and it's gonna have to go.
Not very different though from our regimes.
That's true. No, I guess in the way it functions, no, but at least I mean the West still has an idea of individual liberty, whereas I don't think the Chinese see that as a value at all, other than maybe a temporary expedient. There's still a feeling in the West that individual liberty is a good thing in and of itself. In China, that was never there.
Well, yeah, I'll answer that first. Uh, Earlier, well, in the middle of last week, gilt yields, government bond yields in the UK were really spiking. Not very sharply, but they were making like 27-year highs. And then all of a sudden they turned around and went down. Yeah, the Bank of England, they do a lot of these short-term repo operations. I think they've pumped already they like 70 billion pounds. I think they're playing a losing game because yields are gonna eventually go a lot higher. They might be able to keep it down. I mean, they dropped quite a bit on Friday because of the weak non-farm in the US and in the UK as well. As far as banks failing, I mean, that's possible because banks hold a lot of government bonds, and if government bonds go down, their balance sheets don't look as good. Yeah, the whether the Bank of England is intervening in the government bond market and whether you think there might be some banks in trouble. Maybe you don't follow the UK.
Well, I have been following the 30 the long dated bonds. I mean, Alistair McLeod has been talking about this a lot. UK 30-year, basically a lot of countries in Europe, Germany, France, the long dated bonds are the yields are rising. And the question is are the central banks interfering directly in buying bonds? It might not be direct because if it was direct, you would see it on their balance sheets, and we're not seeing those balance sheets expanding. But that doesn't mean they're not applying pressure to whatever their subordinates are and saying, if you don't buy these bonds now, you're not gonna benefit from our bailouts later, or however they're doing it. I don't know. I mean, there's other ways for them to act other than directly buying bonds and putting them on their balance sheet. They know that we're on to them. So they might try to find other discrete ways to accomplish these things. But basically what McLeod says, what Alistair says is correct, that once the long dated gilt and French bonds and German bonds or whatever's holding the Eurozone together, I know the UK is not part of the Eurozone, whatever's holding all this spit together, uh, if it falls, then everyone is screwed. So
Yeah.
however they accomplish whatever manipulation they do, they'll do it and they'll try to keep it out of our view.
I mean, I thought commodities were going to start a bull market in the early 2020s, only because bonds, I thought were going to start a bear market, and I thought hard assets will benefit in relative terms. But we see now that, banks like Goldman Sachs, who usually just push paper and derivatives, they're actually telling their clients to diversify into commodities. And they even, I think they said that they expect gold well above 4,000 by mid 2026 if the Fed's independence is damaged. So I thought that was interesting.
Mario was skeptical of Bank of America's projection of silver at $42 by the end of 2026, noting that such a target hardly counts as bullish given current price levels. He pointed to technical patterns, such as gold's breakout from a symmetrical triangle and the declining Dow-gold ratio, which he compared to conditions ahead of the 2007 financial crisis. These signals, in his view, highlight the importance of being prepared for turbulence. He echoed this concern with Rafi's analogy that inflation is like a gradual theft, hard to detect at first but eventually triggering panic and a rush into tangible assets. Mario reminded listeners that financial gains in gold, silver, and mining stocks, while positive, should not overshadow the importance of maintaining mental and spiritual resilience, since true wealth goes beyond money alone. Building on this, Rafi suggested a research angle, evaluating whether banks' long-term gold forecasts, often seen as conservative or misleading, have ever truly provided value. Together, these perspectives stress not only the limits of mainstream financial guidance but also the need for deeper personal and strategic preparation in times of economic uncertainty. Let's get back to the interview.
The other couple of weeks ago, Bank of America, which is another bullion bank, they said, "Oh, we're bullish silver. We see silver at $42 by the end of 2026." And I thought, that's not bullish. We're almost at 42 now. So, the bullion banks, I mean, I've been following them since I started following gold in '02. And I mean, now they can't do it anymore because gold is in a massive bull market. But for example, a few years ago, if gold was like 1,500, they'd say, "Oh, in the next few years, we expect gold to revert back to 1,000," and like so on and so forth. But now, they're saying they're bullish, but I think they're not bullish enough. And one of the reasons is these couple of charts here, and I'm going to bring them up. First one is a bit more short term, and this line here, we're going to see in the longer term chart. I think it's really important. And it was around 2,700, this line. And that's why I think we saw this pullback, in the retest. And now as well, I mean, we've broken out of this pennant or symmetrical triangle, and it's really taken off. And there's nothing like above here. So that's very bullish. I'm not saying we won't see any corrections, but and then this one is the same chart, but really long term. And this is why that 2,700, in my opinion, was so important. And I was waiting for that
Wait,
test.
Mario, can you flip back to the other one so I can see the
Yeah.
difference for a second? Okay, yeah, and then go to the forward. Okay, okay.
So this is from the high in 1980 to the high in 2011. That's where that 2,700, when we're breaking out here, I thought we might see resistance at 2,700. I mean, we didn't initially because it went up quite a bit, and then I think, I'm not sure, it went 2,900 or something, and then it broke back down. I think it was after the Trump won the election. But
Mhm.
now, I mean, we're really taking off, and a lot of people don't look at these long-term charts, and this is why I think, yeah, people are concerned about a liquidity event and that gold might drop in miners. But when you look at this, I mean, you just need to sit tight. Like Jesse Livermore said, the people who make the real money, the big money, they're not more smarter than anyone else. they just more patient and they just sit. Just wonder what you guys think.
Mario, I was thinking, what would be an interesting research project is to plot the price calls of banks. Let's say like what did banks, the big banks, when they said, well, what do you think the price of gold's going to be in 5, 10 years out? What did they think in 2003, 2004? Were they
Oh
saying
yeah, yeah.
1900? Like, are they ever right long term? Like, is there any value to anything they say?
This one here is the Dow Gold ratio, and we dropped quite a bit in April when we had that beginning of April, and then it's being consolidated, and now it's breaking down, and it looks a little similar to this. And this was in '07 before the great financial crisis, but I mean, we'll have to see anyway. Yeah, but in Weimar, it started taking off. The hyperinflation really picked up in the summer of 2022, 1922, and by the
Yeah.
1923 it was over. So it was about 18 months. I mean, von Mises says, the crack up boom or hyperinflation, he says it takes weeks and months. People just and this chart, this looks like the chart of gold that we have, even though it's shorter term. And this looks like 29 well, yeah, 2011 to 2024. And now we've broken out. And I think we're kind of like maybe it was a correction here. I don't know, like we had in the last 4 months. But it looks I mean, I've been comparing these two charts on my channel, and it looks a bit scary. And like I think Rafi said earlier, it's uh, it's not nice to see people like, you know, yeah, finding it really tough to get by, and they're not prepared for this. I mean, it's one of the reasons I've been making my videos for 10 years too. And I've always been told, oh, you're crazy. We're never going to have hyperinflation. But I think it's coming because, like all of you guys said, when push comes to shove, the central banks they're going to keep printing. And he says, but then finally the masses wake up. They become suddenly aware of the fact that inflation is a deliberate policy and will go on endlessly. A breakdown occurs, the crack up boom appears. Everybody is anxious to swap his money against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them. Within a very short time, within a few weeks or even days, the things which were used as money are no longer used as a medium of exchange. They become scrap paper. I put scrap digital entries as well.
Same
Nobody,
thing.
yeah,
Yeah.
nobody wants to give anything away against them. So, Rafi, you have a really good analogy about inflation. It's that when it's like someone comes to your house and steals some of your apples, but you don't notice, and then they start stealing loads of apples, and then you notice, right? The other thing that's important, yes, the money and the fact that gold is going up and silver, the miners, and we're doing okay, is nice. But what's more important is like mentally and spiritually and how you are. I think you got to keep doing things that create value because yeah, money on its own is not worth much, if you're doing I don't know. I think you guys understand that, but
Yeah.
you're not just doing things for the money. You're doing things to try to create value for people, and hopefully, that will help you.
So
No, I don't trust the World Gold Council. They're owned by the central bankers.
Markets anticipate Fed rate cuts, with debate over whether it will be a gradual cycle or a swift drop to zero. Gold and silver stand out as key safe havens amid central bank liquidity injections, fragile bond markets, and rising systemic risks. Bank forecasts are often viewed as too cautious, while technical indicators point to much higher potential. Historical parallels to hyperinflation underscore the need for preparation, while true resilience lies not only in holding hard assets but also in creating lasting value beyond money. How might rising systemic risks and central bank interventions reshape investor confidence in gold and silver over the next few years? Stay tuned. If you're interested in real, data-backed insights on the financial system, be sure to like and subscribe so you never miss weekly updates. Thank you for your support, and we hope you enjoy the video.